everybody. My name is Julianne Peterson, and I am excited for tonight. Zoom at 8 every Tuesday night. We are here. I am a loan officer. I am a senior director at Old Capital Lending, and I am your host every Tuesday night for Zoom at 8. We've been doing this for 3.5 years, and I think that Kenneth Sumners has been here for the last 3.5 years. I think I can't remember. You've been here a long time, Kenneth. So you and Shaka have been here for a long time. So I appreciate that. And JT too. So listen, we are at Old Capital. We are premier providers of debt. So if you're looking for multifamily debt, and boy, oh boy, it is crazy right now. I would love to have the opportunity to help you. We will look to help you with bank, bridge, agency, CMBS. We can also look at insurance. If that is something that you're looking for, maybe even looking at, retail, office, mobile home parks, storage, we can also help you with that. We've been in business for 37 years, I think as old as Jeff King is. So, and Jeff King is here with Ramey King along with JT Lynch. So we've got lots of vendors in the house, and I bring a lot of people together again every Tuesday night so that if you're new and you're trying to figure out how do we get this done and how do we partner, this is a great way to do it. We bring these people together so you don't need to build your own Rolodex. You can do it here. Build your team. All right. So being a lender, we bring 70, 75% in the good days. Right now, we're bringing only about 50, 55, 60% of the deal, of the transaction to the deal. So you're going to need 50% of your capital coming from capital raisers. So you got to build those relationships with investors, with capital raisers, with people who are going to bring the rest of it. But you're also going to need plumbers. You're going to need insurance brokers. You're going to need agents, right? Your real estate brokers. So you can find them here. Let's get on with the show. Tonight, I am super excited. And as I mentioned, I got a little crush on our speaker tonight. Rob Beardsley is with us tonight. I've been watching him for the last 4 years. Rob has, he grew up in the Bay Area, actually Silicon Valley. He started playing football and golf in the Silicon Valley, where his parents ran a real estate business. And as a result, Rob constantly was soaking up real estate and business insights and began contributing to the business at a very early age. And he was fascinated by this investing idea, and he continued to explore his intellectual curiosity while attending Carnegie Mellon University, which led to his dropping out. And in 2018, he founded Lone Star Capital, which is a multifamily investment firm focused on acquiring and operating workforce housing throughout Texas and the Southeast. Since then, Rob has been involved in over $300 million of multifamily acquisitions and published a number one book on multifamily underwriting called The Definitive Guide to Underwriting Multifamily Acquisitions. He's also just dropped another book, a second book in September, called Structuring and Raising Debt and Equity for Real Estate. It's available on Amazon, as well as The Definitive Guide to Underwriting Multifamily Acquisitions, also is available on Amazon. He has written over 50 articles and hosts the Capital Spotlight podcast. Write that down, the Capital Spotlight podcast. You got to tune in. Rob currently lives in New York City, where he enjoys reading, traveling, working out, golfing, and playing piano. Rob's passion for teaching goes all the way back to middle school, where he was a math tutor in high school where he was a piano instructor. I am super excited to introduce you to you tonight, Rob Beardsley. Rob, welcome to Zoom at 8. How are you?
I'm
You're on
sorry,
mute.
I'm muted.
There
Well, I'm
you
doing
go.
great. It's I haven't heard that lengthy of an introduction for myself in quite a while, so greatly appreciate it. That was great. Thank you.
Well, listen, again, as I mentioned, I have been watching you for the last 4 years. What I loved about it most importantly is, I guess what you're 25 now, and I don't want to focus on that, right? But you were 21 when I found you, and you were getting dressed up like a young professional. And I thought that was amazing. And that for me was the number one thing that stood out. I was like, this guy is different. And I thought, I gotta tune in. I gotta find out, he's kind of special. What's he all about? And then I heard your name, and I saw you on the internet, and I kind of was watching you, and people were talking about you, and I tuned in more and more, and I was really impressed. So I thought, you know what? I just gotta find out what's going on here. And so I've been following your trail. I've been watching you, and I've been super impressed. And as I mentioned, it's taken a lot of gumption for me to ask you to come. And I just am so thrilled to bring you here. And there's 4 things I want to talk about tonight. Now you can go ahead and talk about whatever you want to talk about, because you got a lot. I mean, you have a wealth of knowledge in so many areas. And I guess that's also what impressed me. You don't just focus on one thing. You have an underwriting model. You know, you did that. I was like, wow, you you also talk about capital raising. You talk about partnership structures. And then you also talk about debt structures and equity structures. So I kind of want to go through those things. Is that something that you would be able to talk to us about?
Absolutely.
All right, cool.
And I love the comment about dressing up. You know, a lot of people poke fun or question, oh, you're wearing a suit, you're wearing a tie, the tie is dead. And I'm not disagreeing with that. You know, certainly we're seeing less and less people dress up, but we did finally move into our new office at the One World Trade Center, and it is no employees are allowed in without a tie. So we are suit and tie 5 days a week in the office, and I don't know about everyone else there, but I love it.
Isn't that interesting? I didn't know that. But you were wearing a tie before going there, right?
Correct.
So that was just part of you. Now, that's not a common thing for a 21-year-old guy, right? I mean, that's not a common behavior. I mean, right? I mean,
No. I mean, it just it felt, well, I guess you could say that when I started, right? I mean, we're talking about my age a lot, and I used to be really shy and insecure about my age, and I'd want to hide it. And now that I've gotten older and more successful, I'm more comfortable with it. But when I started out, I did everything I could to hide my age, and I wanted to appear more experienced, appear older. And so certainly dressing up and looking the part and wearing a suit and tie was a part of that. So that was definitely a consideration back then. But regardless, I always did feel, the value in tradition and taking oneself seriously. And so I think that it, is shown with our employees when they, when our team comes into the office, we all feel like we're all a team because we all are dressed the same and we all have a common goal, and it's important.
okay, so I just want to thank you for wearing the suit and tie and coat tonight, because I had kind of reviewed your videos, and there were some, not all, a lot of them there where you had a t-shirt. I was like, oh, I hope he wears the suit and tie. And I was like, oh, thank you. You did wear it. So thank you very much for doing that, because I was really looking forward to that. So let's talk about first thing I met you. I mean, this is the first we're meeting, but the first thing that stood out for me is that you were underwriting. Tell me a little bit about that. How did you decide to get involved with underwriting? were you inspired by somebody? I mean, this really takes somebody that has a wealth of knowledge of numbers, of spreadsheets. Kind of tell me how that you got started with that.
When I first got started in multifamily, I wanted to understand the business. Like I'm sure all of us wanted to understand our business. And I had a numbers background, went to school for computer science, and I've always been attracted to spreadsheets. So for me, understanding multifamily was a process of understanding the numbers that drove the returns. And that was what initially attracted me to underwriting. And I have to give credit to my dad as far as why I actually went out and built my own model, because in my own mind, I thought practically it would be the simplest thing just to find an existing model and use that, because why recreate the wheel? I'm sure there's something like that out there. Everyone's already got a great model. And I don't even know if he really knew how good his advice was at the time, but he told me, no, you're going to build your own. And I, like I said, I kind of disagreed with that. I thought that would be a waste of time. Why recreate the wheel? But he was so right. It was such an amazing move on so many fronts. So number one, I think to understand really the numbers and how the returns come together and what inputs and assumptions drive different outputs, I think building your own model is one of the best ways to learn it. So even if you're building a model to not necessarily use day in, day out, it just the process of it is very pedagogical. You'll learn a ton and be able to understand the model. There's no other way to understand the model. And so that was a really big thing for me. Number two, that was really big, was actually making the decision to give the model away for free. And at the time, there was a lot of people that told me, well, look, there's other people that sell their model and they sell it for $250, $500. You could be making so much money. Don't give it away for free. And it's not like I'm this altruistic person that just wants to help everyone and give things away for free. But my thought behind it was originally, how could I charge money for something that I would in another way give to my investors for free if they wanted to understand and learn more about investing with us, right? If they're doing due diligence on a potential deal and they want to see the model, I have to show them the model. I can't say, well, I'm sorry, my model is for sale. He says it's private, right? So for me, it was a simple answer. But then the secondary effect of giving it away for free is the growth of our network. And like the whole reason why we're here tonight and why you're doing such a fantastic job bringing this group together is for the network. And if I would have sold my model, I would have missed out on at this point, maybe probably 8,000 people that have downloaded it. And that has attracted people to want to get to know us, work with us, and so on. So that has been really a huge element to our success. And so now that I did kind of that on accident. And now that I'm looking back and going through different educational programs and understanding marketing more, now I understand, okay, that's called a lead magnet. And you need to have a lead magnet that is worth $50 plus that you're willing to give away for free. So if anyone on this call is thinking about how do I grow my email list, how do I get more people in my network, you have to give something away for free that people will be willing to give up their email address for. And, I guess that magic number in the marketing world is $50. So for me, personally, I think my model is worth well in excess of $50, but that's how I think about things when I'm talking to people and saying, well, you should create an ebook or a video course or, this spreadsheet and give it away for free.
Amazing. I mean, great thought. Now, do you also do a class using your model as well? Or do you give any insight on how to work with your model?
Yeah, there's a few pieces there. So I did at one point create a course because I thought, well, I should create a course, and I see people that are making courses and making money. But again, I kind of did it reluctantly, but I had a friend that I have a friend who was a former nurse, and he created a course on how to pass your nursing exam. And he makes $500,000 a month selling this course. So he told me, you're coming to my house, we're putting a script together, and you're making this course, and I'm going to put it together for you and sell it for you. And I thought, oh, wow, I'm going to be a millionaire. This is going to be amazing.
Wow.
But, and we did it. We made a course and it was great, but it wasn't me to sell the course. It didn't feel, not that it didn't feel right, but I just wasn't passionate about it. So fortunately, I got really lucky here. My good friend Hunter Thompson, who was just launching a new mastermind group called Raise Masters, which is an awesome group like this. There's a educational component to it. There's a networking component to it. So he actually bought my course to incorporate it as part of his Raise Masters modules. And so people love, and so it's the only place you can get the course. So people love it. Hunter loves it. And I love it because I don't have to worry about, selling a course anymore and people asking questions and things like that. So that's the course situation. But as far as just anybody wanting to use the model and learn more about, even if you're not using the model, just learn more about our underwriting process. We have tons of YouTube videos that are walkthroughs and kind of give away some of that secret sauce, even though it's not secret at all. And then, like you mentioned before, my first book that I wrote, The Definitive Guide to Underwriting Multifamily Acquisitions, I wrote that book. It was the easiest book in the world to write because I just pulled out my model and I just went step by step through all the inputs and said, okay, unit mix, okay, other income, rubs, vacancy. And I just went through every single thing that in my process as far as how I'd underwrite. And then I just wrote the book on it. So it's a very boring book, but for those that are interested, it's been a very good, niche tool for people to fill that gap, because there really isn't any other book out there on the market that is straightforward that addresses this concept. There's textbooks, but they're very they're very abstract, and this is just straightforward. Here's how we do it. And when I was learning the business, to me it felt like a lot of people had a very private or opaque underwriting process, and they kind of made it seem like they have a secret sauce or they have proprietary way of doing things. But in reality, we're all just doing simple math. We're all just looking at income, expenses, interest rates, growth rates, cap rates, and that's pretty much it. So I just wanted to demystify it and make it accessible to even people who are passive investors, because I want a passive investor to have confidence in the numbers, because I know a confident investor is an investor who will actually invest, right? Like they say, a confused mind says no. And that's what what's one of my goals with the book.
That is so fantastic, because you could even, as a general partner, give that to your investor and say, check my math, and it just, like you say, makes them feel more confident. I love that. That is really a fantastic approach. Now, I'm curious, over the 4 years that you've been underwriting, things have changed for you. You think, we all grow, we expand, we get more knowledgeable. You look back at, 4 years ago, you wrote that 2 years ago. Are you looking at things differently? If you were to go back and rewrite that book, would you change some of the entries in it? I know you've talked about cap rates. Just recently, I think you did, well, I don't know how recent it was. You did it with Dave. You did a podcast, not a podcast, but a YouTube video with him. And you were talking about cap rates and operating reserves and putting things below the line. And, you kind of broke things out. I'm curious, you've learned a lot over the 4 years, 2 years since you wrote the book. If you review what you wrote in the book, is there anything that you would change today in how you're underwriting deals, and that would be helpful for our watchers, that are people that are underwriting their deals now, that have made an impact for you?
So it's actually funny because I just last weekend recorded the audio for the audiobook version of the underwriting book. So I reread the book, so it's fresh in my mind what
Yeah.
I wrote, and it's quite interesting because as I was reading it, I was thinking, oh wow, we actually do look at this a little bit differently, or
Mm.
yeah. So we have changed for sure, and I think high level, just high level, I think back then I was obviously less experienced,
Mhm.
and we were still in a very competitive market, but we were in a market that wasn't super frothy, and so I at that time was more conservative, to be honest. To be honest, we've gotten
Mm.
over time, as we've gotten more comfortable and we brought operations in house. We have a better handle on our operations, and we've had success in the portfolio. We've gotten more aggressive with our underwriting, and there's two reasons for that. The first reason, as I explained, the comfort level and the experience that gives us that confidence to be more aggressive, and then secondly, as the market has gotten hotter and hotter, and now we're in a slightly different market, which we'll talk about. But the reality is, you can't you can't be the most conservative investor in the world and expect to buy deals, because there's plenty of other buyers out in the market, and they'll just outbid you. So the reality is, I think the thing that first book is missing is the nuance that we have learned in the last few years of, you need to be aggressive somewhere. There needs to be some optimism in your numbers, so that way you can actually make the deal work. If you're just pessimistic or just really safe everywhere, then your returns are going to look too low, and your investors aren't going to be excited. So you have to be able to project, some optimism, some excitement, in order to get the deal done, while still keeping risk under control. So that is where the magic happens. And so that's at a high level. And then, there's on a more nuanced level, there's all the market's always changing, as we're all experiencing now, with the 10-year going up, and now the 10-years come down a little bit. Like you mentioned earlier, leverage is way down. And so
Mhm.
all these things have shown us, new insights, new ideas, and new ways for us that we have to adapt in order to make deals happen. So
So
that's
let's talk about that. All right. So over the last 2 years, we went through COVID. You went to bridge, I'm sure, like everybody else. Did you put caps on them? Number one.
yes.
All your deals had caps or no?
Yes.
Mm, good job. Uh, you know, a lot of people are running out of steam right now because they didn't, right? They have no cash flow. Um, so you're looking at, okay, how am I going to get out? How am I going to get out of this bridge? I'm sure you've looked at, okay, when am I exiting to get either I'm going to get into something that's more stable or I'm going to sell. You're looking at your existing assets. What are you looking at? Are you looking at let's get out or let's move through this as quickly as possible? Or are you going to take them to 3 years, or each one is kind of different? What do you talk to us about that?
Yeah. So this is definitely the challenge in the market today for many owners like ourselves, who bought deals in the last, I'd say, year to almost 2 years, in that time period, with floating rate bridge
Mhm.
debt, because you likely put more leverage than what is easily refinanceable today, and your floating rate loan has gone up a lot. You're in the money on your cap. Your replacement cap cost is really expensive, so you have a looming large expense coming up. So
Yeah.
it's a tricky thing of managing cash flow as well as managing your maturity on the bridge loan. And the answer, or the route to go down of refinancing into a fixed rate loan, is not so straightforward. It may sound like a
Yeah.
really simple or no brainer thing to do, but there's two big issues with that. The first one is, you may be fixing today. Now, today is a little bit interesting, like we talked about, because the 10-year has come down quite a bit. So fixed rates are actually looking pretty attractive, but we still have fairly high fixed rates, I would argue. And if you fix today, you're risking locking in a high rate today, and then floating rates float down, and you're missing out on that possible float down. So if you floated up, and then you took out and went to fix, and then if rates float down, you're missing out on that. So there's the little bit of interest rate forecasting, if you will. Where do you think rates are going to go? If you're in the camp that rates are going to be higher and higher for longer and longer, then yes, just refining now, selling now, doing whatever you can is your strategy. But if you are of the mind that you think, well, the Fed's probably going to do a couple more hikes and then we'll probably go into recession, they'll reverse course and start cutting like they normally do, then you are put in this middle position. So that's the first thing. And also, I'm a big fan of Pensford, the Pensford letter. I love reading the Pensford letter, and that they're interest rate experts, if you will, and they have research that basically shows historically when fixed rates are lower than floating rates, that is paradoxically the worst time to fix your rate. And what that means is today, that's exactly what we have today. If you look at the yield curve, it's dramatically inverted, where the short end of the curve is very high. And then, the 10-year is still high as far as recent times, but it's still lower than where short rates are. And so basically every time in history where we have long-term rates that are lower than floating rates, what that implies is that sometime in the near future, we're going to see a dramatic decline in floating rates, and we're going to go back to a healthy yield curve, which is a steep yield curve or a positively sloping yield curve, where the short end of the curve, which means SOFR, the 2-year treasury, is less than the 5-year treasury bond, 7-year, 10-year, and so you have that positive sloping curve. So that was a long way of saying that it's not so simple. But to answer your question, what we're doing is we are, in fact, biting the bullet on most of our deals and refining into fixed rate. And so the reason for that is not so much an economic one, but more so an investor relations motivated decision. And so this is actually very interesting and something that I hate to have learned through experience, but it is what it is. And that is that, yes, it's important to be really smart and think about how we can maximize and do the best deal we can. But at some point, you have to think about investor optics. You have to think about your reputation and the reality of what you're actually in business for. And so if we truly think about what we're in business to do, it's not necessarily to deliver the highest and absolute best returns and the best deals for our investors. The way I think about it, and everybody's different, but the way I think about it and want to run our business is the product that I'm actually delivering to investors is peace of mind. It's to be able to sleep at night. That's my product and service that I want to be able to give to investors. Investing is stressful. Investing is risky. And so I think being that solution is extremely valuable. So with that in mind, with fixed rate loans, you really are just putting that variable of the entire equation, you're taking it out. And that may cause you to miss out on some of the absolute upside or what have you, but it's certainly going to mitigate your downside and mitigate the fluctuations in performance and distributions, et cetera. So, like I said, it's unfortunate to have learned this lesson through this rising interest rate environment, but I think that's going to color the way that we think about and approach deals moving forward, as evidenced by the new deals that we're acquiring right now. Everything is on a fixed rate right now. So yeah, so that's really the main reason I would say why we're refining into fixed rates. And we're really fortunate to have a very healthy portfolio where performance is strong, where we are able to refi out of the floating rates into the fixed rates.
Hey, I love the idea. I haven't heard it put that way. Peace of mind. I love that. I think as I step back and I think about my limited partnerships, and I think about my distributions that have been taken away, and I listen and I read the newsletters that say, hey, I'm taking even more away because I have to put not 81,000 a month, but 120,000 a month towards this rate cap that is a 1.2 million in 9 months. We bought it at 24,000 a year and a half ago, and now it's 1.2. I mean, just craziness. To take that all away and to give me a little peace of mind. I love that. That is really, that resonates with me. I appreciate that. Now I'm going to move forward with the idea, and you touched on this, going into new deals. that you've got some deals, which is great. I love that. You are putting some long-term debt on it, which is meaning you're going to go into lower leverage deals most likely, because we're not seeing 75, 80% today, right? So the question is, how is the capital raising going? That was the other question, because that's raising capital. That was one of the questions I want to talk to you about. You talked about in one of your, I don't know where I found it, but the sniper approach. Talk about sniper approach of getting people to look at your information about, you know, raising capital. This is a terrible, I don't want to say terrible, but it is a challenging time. How are you attracting capital? How are you getting this sniper approach to get people to look at you and look at these deals at the end of the year when it's uncertain and we don't know what's going to happen in the next quarter? I'm really interested to know.
Yeah, so we have also experienced definitely a more difficult environment, especially when you look. So if you divide the world up into high net worth individuals or accredited investors, and then more sophisticated professional investors like family offices and private equity firms, on the accredited investor side, you have investors who have kind of shaken confidence. They're more hesitant. They're looking at their stock portfolio. They're looking at the news, and they don't necessarily think it's the best time to invest. And I'm not necessarily disagreeing with them. So
Yeah.
that's the one reality. And then on the flip side, with the family offices and the private equity firms, they have capital raised. They're very flush. There's not a liquidity crunch in the world right now. This is very different. This is a very different situation than, you could say maybe like a credit-driven recession. We're not there yet, at least. And like I said, they have lots of capital. They'd like to deploy it, but they're very picky. And they also are thinking, well, they don't want to be the fools that maybe invest today when they could get better pricing tomorrow. So for those investors that have the luxury of waiting, it's somewhat compelling to do so. And that's why we're seeing a lot more no's, or, hey, we're on pause right now. We're pencils down right now, and we're waiting. Yeah. So that puts the pressure on us to make sure that whatever deals that we're pursuing, we have the confidence that the deal makes a lot of sense, because you are in an environment right now where it's very, very likely that whatever you buy today will be worth less 6 months to a year from now. Mm-hmm. So you have to buy deals that make sense with that psychology. So how do you overcome that? You overcome that with a longer horizon, right? If your deal horizon is 5 years, just as 5 years, which isn't incredibly long, but just as an example, if it's 5 years, then you can withstand a decline in valuation over the next year or so, and then wait for values to rebound. So that's why, like you mentioned before, long-term debt is so powerful, especially with a fixed rate, because you're eliminating variables. You're pushing out maturity risk into the future. You don't have interest rate risk. So that makes it just a much easier deal to invest in today. So, really, bridge loans for us today are off the table. And really, the best deals that we can make sense of today are loan assumptions. And that is a great way to bridge the gap between what sellers want you to pay and what you're able to pay, because of, the intrinsic value of whatever loan they have in place. So loan assumptions are attractive in today's environment. And then anything that you can buy with some decent going in yield, so that way you can get the leverage up on a permanent loan, right? Because as I'm sure many of you know, if you're looking at a permanent loan from a bank or Fannie or Freddie, that's going to be sized based on the in-place income of the property. And in order for you to get 60, 70% leverage, if you can find it, you need as much in-place income as possible. So it's almost the reverse of a value add, because when you're buying value add property, you're usually buying less and less income, which means a lower and lower cap rate. So it's tricky. It's tough because you can't necessarily have it both ways. You can't buy a lot of in-place income and have a great value add. So you have to find that right balance. But I think this lower leverage, where we're forced to have lower leverage, I think it's actually quite healthy and refreshing.
Yeah,
It was tempting to use higher leverage when it was available because it was so
very
cheap,
much.
but um, it's just riskier. And so this this experience, I think, is training a lot of us and our investors to actually understand that maybe accepting a slightly lower return for a lot less risk is actually a great trade-off.
I love that. I mean, you should put that everywhere, because I think that this new regime that's come in over the last 3 years, we've been sitting at our desk. How can I make money? I'm bored. I got all these people with money. We leveraged, everything, 75, 85%. I think people got used to this, fix and flip model, and it was somewhat dangerous. I mean, seriously, that's not how we did deals back in the 80s and 90s, 2000s. That's not how we did deals. You had 2 or 3 people on them at best in the 2010, right? Now we've got many, many people on them, trying to make these deals work. And, I think going back to the basics, lower leverage, less risk. I think we need to get back to the basics. I think you're right.
Yeah, real
Now,
estate is a get rich slow game, and a lot of
yeah,
people have been really fortunate to get rich fast recently,
yes,
which is amazing. And I think there will be opportunities again to get rich quick. But at the end of the day, it's really a slow game, and I think that is at least our preference to operate, because we're going to be in business for a long time, and like I said, we're in business for our investors and to provide them the experience, that that smooth experience that we talked about. So that's definitely shaping our thoughts about the market.
so the third thing I wanted to talk about is the partnership structures. And I'm talking about this more of, now I'm thinking about how when you started this, you probably didn't have the same type of investors you do now, right? You had probably less sophisticated than you do now. And I really do want to ask you, how was that transition to go from your retail investor to now a much more sophisticated, more institutional investor? What did it take? Because I think that is some of the struggle and some of the concern of people that need to go to the next level. How do I get to that next investor? And, you're 18, you're wearing a suit. Are you able to attract that big capital? Now you're 22, whatever, you're 25. You're able to be people to take you seriously. I don't care how old you are. There is a level of understanding and presentation and being able to sit in front of CEO, in front of very organized and I don't know, wealthy individuals, right? And you have to have a sense of confidence. How has that changed over time for you? And what would you recommend? Is there a book? Is there an experience? Is there a mastermind? What is your recommendation for our listeners here? Because I think that's a challenge.
Yeah, it's a challenge. And I think what's interesting is actually, before you ask the question of how do you do it, I think what's interesting is a lot of people don't want to do it. And so some people may think they want to, but they don't actually want to.
Mm,
And there's also very successful syndicators that will tell you that they actually want nothing to do with sophisticated investors or family offices or private equity, because they're happy with their syndications, with their retail investors, and that's their lane. So I think it's really great to hear and exciting to hear other people who want to partner with sophisticated investors and build up the team, the track record, the positioning in order to do so. So that's kind of the first start. The first start was way back early on. My business partner and I, we wanted it. We were really attracted to doing business with smart people that had more experience than us, and that we could learn and grow with. So from the very early on, we positioned ourselves with that in mind. So everything we did with the lens of, okay, what if a $500 million private equity firm were to look at us, or to look at our website, or to look at our deal? And what would they say? And so being buttoned up to that level it doesn't take that much work, but it does take that thought. You have to have that thought and that intentionality. But what I really like is, speaking of, resources and stuff, I really like Richard Wilson. He runs the Family Office Club, and we actually shared the stage last week at a conference in Dallas, and he said, and I love this because I totally agree. He said, if you make yourself, professional enough and robust enough to be able to approach the sophisticated capital, then it's going to do well, and you'll be fine with everybody else also, right? You might alienate some people who maybe aren't really looking or thinking at that level of sophistication, but for the most part, if you take that approach and apply it to all of your investors, you're going to do well. And that's exactly how we do it. We treat our small investors just like our big investors. So in the end, we have even if they might be a retail investor that's only investing 100,000 or 250,000, they're still usually quite sophisticated, and this is not their first real estate deal. And that's kind of what we like. And so that brings me up to another point, which is your avatar and your niche, because whether you like it or not, or whether you know it or not, you are niching. Like Jeff King, for example, mentioned that they do all asset classes, but they really are focused on multi. And that may have been intentional. That may have started unintentionally, and then they realized it and went all in. So that's true for everybody else too. Whether you like it or not, or know it or not, you are niching in some regard, and you are attracting certain people and alienating others. And if you do want the bigger capital, if you do want the firms that can write 10, 20, $40 million checks, it requires deliberately thinking about who they are, and then understanding what are their wants and needs and pain points. And if that's not what you want, then figure out the avatar that you want, and then be intentional to attract exactly that. So what are the pain points of that avatar? Well, there's a few things. So first of all, if you're a $500 million private equity firm, you have a certain investment criteria and a certain check size, because you need to invest. You can't go around investing $1 million at a time, because you're not going to allocate your fund. So your pain point is, I've got $500 million and I need to put it to work. So that's pain point number one. Pain point number two is, they have an investment committee. They have fiduciary responsibility to their investors, and they're very sophisticated. So they're not just going to do a deal for the sake of it. The numbers really do have to check out. And finally, well, maybe there's two more, but there's deal flow, right? That kind of actually goes back to number two. They get a ton of deal flow. A lot of people want them. They want other people too. It's a two-way street. They're deal junkies just like we are. So, but because they have so much deal flow, they have the luxury of being picky. And then finally, what do they really want? They want repeat partnerships, because it's such a headache for them to go through this super rigorous sponsor due diligence process, go through investment committee, get approval, and then do one deal and never do another deal. That's exactly what they don't want. So those are some of the pain points. So now that you know those pain points, the next step would be to think, how can I alleviate those pain points for them? How can I portray myself as, like Richard Wilson says, if they have a headache, how can I be Excedrin, right? And you need to present yourself as, hey, I'm a focused sponsor that can provide you this exact type of deal over and over again, that once you get comfortable with me, we can rinse and repeat, and everyone's life is easier. So at a high level, that is, that's kind of our thought process and approach to attracting those types of investors.
So the elephant in the room says, yeah, but they don't allow me to take an asset management fee. They don't allow me to take an acquisition fee, or I got to take a half a point and I don't get this fee and that fee and this fee and that fee, and I make nothing. And they want this and I'm working for nothing. Is that the first deal, or do they, how does that become, hey, can you let me make a little bit on the next one? Or is that an ongoing, sorry, this is the way it is? How has that been for you?
Yeah, there's definitely, that's true. There is a reality there that if you are going to partner with someone that's going to provide you $20 million in one chunk, it's going to come at a cost, as opposed to, $100,000 at a time. So roughly speaking, everyone's structure is a little bit different, and that goes for both people's syndication structures as well as their joint venture structures. But based on my analysis of kind of what I've seen out in the market and then breaking down the numbers, roughly speaking, your fees are around half as much as opposed to a syndication, maybe a little bit more, but around half as much. And then your anticipated promote compensation as a sponsor is roughly cut down by about a third. So you get haircut more so on the fees than you do on your promote. And then if you take it a step further, well, and I also want to answer your other question, which is, can you graduate? And the answer is in my experience, yes, but slightly. It's not like they'll pay you no fee up on the first deal, then you work your way up to 0.5%, then 1%. I usually don't see a lot of deviation like that, but there is a little bit where, maybe it's 75 basis points on the first deal, but then the next time it's 1%. And that depends also on just how good the deal is, how differentiated the deal flow is, and the size of it, of course. But I also think, maybe some of us aren't as used to negotiating with equity, right? Because if you're just putting out a syndication and you're putting it together a PPM, you don't really have investors negotiating with you. They either invest on the terms that are advertised or they don't. But in the private equity world, it's all a negotiation. So I think if someone says they won't pay, like I actually met a private equity firm here in New York a while ago, and it was actually on stage. So we were at an event, both speaking, and I was the moderator. And I said, "Oh, like, what is your typical structure? What's your acquisition fee?" And they said, "Oh, we don't usually pay an acquisition fee, yada yada." Yeah. And I was obviously turned off by that, but nonetheless, I had a follow-up call with him. And on the call, he was more realistic and said, "Yeah, look, we usually pay 75 basis points to 1%." So I think maybe there's an initial offer and then they come back and things like that. So that's the one thing. But going back to the math of it, right? If you're getting maybe paid almost half as much on the fees, maybe a little bit more, and then a third less on the promote, that's the reality between syndication and JV. But now let's say you're a lead sponsor and you're layering in co-GP partners that are helping you raise capital. Well, then it becomes a much fair comparison, because when you bring in partners, you obviously have to share in the fees, you have to share in the promote, and you might end up in the same place if you have to bring in enough co-GP capital to get your deal done. So, and that reality and that math has been exacerbated by lower leverage. Because if you think about it, back in the good old days when we were doing a $20 million deal for $5 million of equity, you're getting a 2% acquisition fee on 20 million, which is 400,000. And all you need to do is raise $5 million. Now, if you're doing that same $20 million deal and earning that same $400,000 acquisition fee, you might have to raise $10 million, which is double the amount of equity. So you're essentially diluting your fee compensation by half because of the debt environment that we're in. So when you look at it that way, it kind of starts to neutralize, not neutralize, but it starts to make the difference between retail and JV less dramatic.
Mm-hmm. Makes you want to say, makes you want to go, yeah. Man, oh man, you've gone so deep and so long, and we've gone through our underwriting, you've gone through raising capital, partnerships, ship structures. We talked about financing. The last thing I want to ask you is words of wisdom. I'm putting you on the spot, and you're doing awesome, by the way. We haven't practiced or anything, so awesome. Words of wisdom for somebody who is thinking about getting into syndication, who may be already in syndication. You're in a partnership. Do you have partnership words of wisdom? Do you have, you could go whatever words of wisdom you have for somebody. What would that look like?
Yeah, sounds good. So I'll give a couple. So first one will stay on partnerships, because my business partner and I got incredibly lucky to find each other and work out so well. We met through a mentorship program. We met at the Best Ever conference back in early 2018, and right after that we started Lone Star, and we were off to the races. So the reason why I emphasize luck is because I actually think that was pretty irresponsible of us. Right, to have met briefly at a conference and then kind of, we dated a little bit. We talked on the phone every day and kind of got our first deal under contract. And then we said, yes, let's do this. So it was luck. But, I think the brilliance of the real estate business is how we are also partnership friendly. And you don't have to get married in this business. You can date and find people that you like to work with. And if you have a deal or a partner that you don't like, well, you don't have to do another deal with them. You can just have closed that deal, you work on that deal, and then you go and find other people to do deals with. So as far as partnerships go, I definitely recommend taking it slow and really being extremely cautious with that. And especially if you are, if you're a rising star and you think you've got, a lot of magic ahead of you, you have to be very careful with who you're just willing to give away, a 50-50 partnership with, if you're going to give away your magic. So you have to really, if you're entrepreneurial and you're going to do something entrepreneurial where you're going to grow something and create a ton of value, you're already putting so much risk on yourself and you're betting on yourself so heavily. You don't want to dilute the spoils of that success by just willy-nilly saying, yeah, I'll give you a piece of this partnership and you own the company, right? So it may be easier in the early stages to partner rather than hire, but then as you get bigger, you're going to think, oh wow, well, I wish I would have hired for that rather than bringing in a partner. So that's my thoughts on partnership. Then the other thing is, which is maybe a little bit before you're even ready at a stage of partnership, and this is kind of applies to a lot of younger people that actually, for whatever reason, young people are inspired to reach out to me, right? They see themselves in me and they say, oh, wow, cool, I can do that too. And that's great. The problem often I see with young people reaching out is they just really have no idea how to network and to reach out to their advantage. Because if you reach out to somebody just asking for value and not offering any in return, it's not going to go anywhere. So you have to find ways, even when you seemingly in your own head, you feel like you can't add value to somebody, you have to find a way, and you have to fake it till you make it if necessary. And so there's 3 ways that you can add value to someone in such a way that they would be interested in actually providing value to you. And those things are money, right? Maybe you can make them money somehow. That might be difficult if you're starting out, but maybe there's some way that you can do that. Maybe you're willing to work for free. But even then, that's when someone comes to you and says, if someone comes to someone who's big and important and says, hey, I want to work for free, that important person is thinking, well, that sounds like a headache. So you have to be careful with that and thoughtful. No risk. But so the three are money, status, and friendship.
Mm.
So those are the only reasons why we would really, and when I say we, I just mean we as people, why we would want to really help each other out. Yes, some people, yes, we do like to give back, but that's that friendship element. So as my big advice is, I really, and I shouldn't let it bother me, but I heard someone else say it, so I have now started saying it. I heard someone say their biggest pet peeve is when someone says, "Hey, can I pick your brain?" So I just agree with that as well. I say, don't say pick your brain. Find something else to say, because pick your brain basically just saying, "Hey, let me just extract value from your brain and offer nothing in return." At least offer some way, "Hey, maybe I've got a deal that we can work on or something," right? So just keep that in mind when you're networking and reaching out. It's money, friendship, and status. Maybe there's some way that you can elevate their status. Like, for example, what we're doing tonight is incredibly, incredibly powerful. Somebody could, with a little bit of legwork, create a platform like this where they would be able to then network and create people, invite people onto their platform, and that's elevating other people's status, right? We're able to now be in this room because of Julie, and that's elevating her status in turn. So money, status, friendship.
It only took me 3.5 years, Rob, to get you on here, to get the courage to have friendship, to say, "Hey, can you do that?" So I'm a little slow, but anybody can do it, right? Yeah, man, oh man, Rob, that you are amazing, and it was worth the wait. I'm so thrilled that you were here, that you were part of my audience, that you were part as a guest for us. I am just grateful for everything that you shared tonight. I just learned so much from you tonight. So we're all learning all the time, and it's amazing. I've been doing this for 30 years and I'm still learning. So it's awesome. I want to wish you so much success. If there's something that I can be doing to help you, I would love to know what that is. And I'm going to probably have to figure out the money, the status of friendship, how I can help you in some way. But thank you again. How would someone get a hold of you and help you? How would they do that?
To learn more about what we have going on, check out our website, which is lscre.com. I'll put it in the chat. And then if you want to reach out to me directly, you can connect with me on LinkedIn, and you can also email me at rob@lscre.com. I'll put that in the chat as well.
Fantastic.